If you've watched my videos about investing before, you know that I'm a big believer in investing in ETFs instead of trying to pick individual shares. But I also know that a lot of people actually want to pick individual stocks, especially US stocks. Now, I'm not going to mention any ETFs in this video, but I have a best ETFs video you can check out. I'll leave a link in the description box as well as at the end of this video. And if you're looking for Aussie shares to buy and hold, I also have a video for that, link also down below. But before we get started, make sure you do your own research. I'm just a guy on the internet and definitely not a financial advisor or a professional investor. And it's very, very important to buy and hold the like button and subscribe if you haven't already. It's completely free to do, but it will help me out tremendously. My first US share to buy and hold forever is Micorosft, ticker symbol MSFT. For full disclosure, I did work at Micorosft. Micorosft is a global technology company that was founded back in 1975 by Bill Gates and Paul Allen. The company started with MS-DOS, a computer operating software, but now creates a variety of tech products and services. I know the video says forever, but from a practical standpoint, we're going to be looking at Microsoft's share price over the last 10 years. Its share price has increased from $25.10 to $250.79, representing a 9.99x return, not including dividends. That means if you had invested, say, $1,000 in 2011 in Microsoft shares, your shares would be worth $9,990. As always, remember that past performance is no guarantee of future results. So why have I picked Microsoft to be included in this video? Well, the first reason is Azure, Microsoft's cloud computing division. The global cloud computing industry is growing at an astonishing rate. In fact, it's projected to be worth $832 billion by 2025. And Microsoft is well positioned to profit off this juicy industry. It currently has 20% of the cloud computing market share, with Amazon Web Services being number one with 32%. What's interesting is just how quickly Azure has grown over the last few years. If we look back in Q1 of 2017, Azure's market share was around 10%. Fast forward to Q4 of 2020 and it is now sitting at 20%. Another reason why I picked Microsoft is because of its diverse products and services. When I mention the name Microsoft, most people will think of either Windows or Office. But the truth is Microsoft has a lot of other businesses within the company. For example, it has Azure Cloud Computing, Surface devices, commercial software such as Dynamics, Xbox, gaming studios like Bethesda, who make Skyrim, and Mojang, who created Minecraft, Microsoft Teams, HoloLens, LinkedIn, and Bing. When you're researching a stock, it's important to consider what kind of risks or challenges that company might face. With Microsoft, one of its challenges is its competitors. The most obvious one being Amazon Web Services on the cloud computing front. You also have Surface competing with Apple and Xbox competing with Sony PlayStation. Another risk for Microsoft is government regulation. Back in 1998, Microsoft was actually accused by the US government of trying to create a monopoly that led to the collapse of rival Netscape by giving away its internet browser software for free. The judge in the case ruled that Microsoft had actually violated parts of the Sherman Antitrust Act and ordered the company to break into two separate entities. Fortunately for Microsoft, the company appealed the decision and it was overruled. In more recent years, the company has had to face Senate inquiries, specifically around the power of big tech. My next US share to buy and hold forever is Amazon, ticker symbol AMZN. Amazon was created by Jeff Bezos in his garage back in 1994 and started as an online bookstore. It's now transformed into an online retail juggernaut, selling pretty much everything you can think of. It also has other businesses including Amazon Web Services, which is its cloud computing division. It has Kindle, which sells ebook and ebook readers, It has Prime Video, which is a streaming service. It has Twitch, the live streaming platform, Whole Foods, and also Smart Assistant, Alexa, and related Echo devices. And as of filming this video, Amazon is actually in talks to buy the movie studio MGM, which owns the rights to the James Bond franchise. If we take a look at Amazon's share price over the last 10 years, we'll see that it's increased from $187 to $3,206, which equals to a massive 17x return, not including dividends. One of the reasons why I picked Amazon to be in this video is because of Amazon Web Services, aka AWS. AWS has dominated the cloud computing industry in the last few years, maintaining a 30% market share. As more businesses around the world continue to embrace the shift to cloud computing, Amazon is perfectly placed to capture those customers and generate more revenue. Another reason why I picked Amazon is because of the diverse products and services the company offers. This enables Amazon to generate revenue from multiple markets while leveraging the company's experience and expertise. In terms of challenges, one of the biggest ones that Amazon could face is government regulation. Amazon has been criticized for having a monopoly on the e-commerce market in the US, as well as the poor treatment of its warehouse workers. If the government did decide to act on this and force Amazon to break up, this could have a significant impact on Amazon's share price. My number 3 US share to buy and hold forever is Alphabet, ticker symbol GOOGL. If you didn't know, Alphabet Inc. is actually the parent company of Google. And within Google, you have YouTube, Android, Google Maps, Gmail, and even Google Cloud. Other subsidiaries in Alphabet include Waymo, DeepMind, Fitbit, and Google Ventures. If we look at the last 10 years, Alphabet's share price has grown from $263 US per share to $2,393, representing a 9x return, not including dividends. The main reason why I've included Alphabet in this list of the 6 best US shares to buy and hold forever is because of its dominance in search and online video, respectively through Google and through YouTube. In 2021, Google had 70.5% of the US search advertising spend, and it's the most visited site in the world. The second most visited site in the world goes to YouTube. In terms of risk, Alphabet is also susceptible to government regulation, especially for antitrust behavior. It's possible that the government could view Alphabet's dominance in search and online video as having a monopoly and could force it to break apart its businesses. Another risk is its competitors. Although Alphabet currently dominates both search and online video, they definitely have competitors that are creeping up. For example, in search advertising, Amazon has actually managed to more than double its market share in the last 5 years. And if we look at the YouTube side, the biggest threat would probably be TikTok, which has skyrocketed in terms of popularity and usage time. Not to mention, TikTok's algorithm is eerily good at predicting what users want to watch. And my number 4 US stock to buy and hold forever is Apple, ticker symbol APPL. Now, for full disclosure again, I used to work at Apple's Sydney office. Apple is arguably the most famous technology company in the world, and as of filming this video, it's the largest company by market cap in the entire world. Not only that, it was also the first American company to hit $2 trillion in market value, doing so in August 2020. Over the last 10 years, Apple's share price has grown from $12.05 to $125.89, which amounts to a 10.4x return, not including dividends. There's a couple reasons why I've included Apple in this video. The first one is Apple's unique ecosystem, which encourages consumers to exclusively purchase Apple products and services. Once you've purchased an iPhone, you're more likely to buy AirPods, an Apple Watch, a MacBook, maybe an Apple TV, and then you start subscribing to Apple TV Plus or Apple Music, or you start paying for iCloud, and then before you know it, you are locked into the Apple ecosystem. And it's going to cost you a lot of money and a lot of time to escape and switch to a different company. Another reason why I've picked Apple is because of its innovation. Now, before any of you accuse me of being an Apple fanboy, if we look at history, Apple has certainly created some innovative and game-changing products. For example, the iPod, the iPhone, iTunes, the Apple retail stores, and even most recently, the M1 chip, which has allowed devices to be faster and more efficient. And last but not least, it's important to note that iPhone is extremely popular with Gen Z. One survey showed that 83% of Gen Z respondents had an iPhone. This means Apple will become the go-to option for the majority of Gen Z customers when they start earning more income and they can purchase more products and services. Like the other three tech companies I've mentioned, Apple also faces the risk of government regulation, specifically antitrust laws around monopolies. In fact, right now, Epic Games, the creators of Fortnite, is actually suing Apple. Epic Games is arguing that the 30% fee that Apple charges on sales through the Apple Store is antitrust behavior. In addition, in April 2021, both Apple and Google had to attend a US Senate hearing facing senators from the Subcommittee on Competition Policy, Antitrust and Consumer Rights, specifically around the App Store fees that both companies were charging. And my fifth option for the best US stocks to buy and hold forever is Costco, ticker symbol COST. As of 2020, Costco is the fifth largest retailer in the world, and it operates in Australia, the UK, Canada, Japan, South Korea, Taiwan, and many more countries. Costco sells pretty much everything and anything you can imagine, whether it's groceries, alcohol, technology, furniture, and even jewelry. That's right, you can pick up a diamond ring for 54,000 Australian dollars from Costco. Over the last 10 years, Costco's share price has grown from $81.35 to $387.52, which represents a 4.7x return, not including dividends. You might be wondering why I picked Costco and not one of the other listed US retailers. Well, one reason is because of Costco's secret weapon, which is its subscription model. In order to shop at Costco, consumers have to actually pay a yearly membership fee. And in FY20, Costco had 100 million members worldwide and a membership revenue of $3.54 billion US dollars. Not only are those memberships an extra source of revenue for Costco, they also allow Costco to have the leverage to negotiate with suppliers for better prices, which it then can pass on the cost savings to consumers. Notably, Costco also has several strategies to increase their customer spending, including their massive warehouse layout, their free food samples, and the oversized trolleys. In fact, one study showed that Costco shoppers actually spend nearly 150% more per shopping trip than shoppers at the average American retailer. And let's not forget the delicious food from the food court that's outside the Costco entrance. In my opinion, Costco's biggest risk is change in consumer behavior. As more and more people embrace online shopping, especially the younger generation, there's a chance that Costco could lose customers to e-commerce. It would seem that Costco is actually aware of this trend, as it does have online stores available to its members in some of the countries it operates in. And my last US share to buy and hold forever, aka Diamond Hands, is McDonald's, ticker symbol MCD. Everyone knows what McDonald's is, and you've almost definitely eaten at the fast food chain at some point in your life. Looking at the last 10 years, McDonald's share price has grown from $85.36 to $233.38, which represents a 270% return, not including dividends. So why have I picked Mickey D's over the other listed fast food restaurants in the US? Well, one big reason is that Ronald McDonald doesn't just sell hamburgers. He's also a massive landlord. That's right, McDonald's isn't just a fast food company, it's a real estate empire. How it works is that McDonald's actually owns lots of prime commercial real estate. It then rents out that prime real estate to franchisees. people who want to essentially own their own McDonald's. So McDonald's is not only collecting royalties from their franchisees, they're also collecting rent from them. Also, the real estate that McDonald's owns will eventually increase in value over time. Another reason why I've included McDonald's in this video is because of its branding. It's arguably the most recognizable brand in the entire world. And in the recent years, McDonald's has inked partnerships with the likes of Travis Scott, Rick and Morty, BTS, allowing the fast food company to maintain its dominance in pop culture. In terms of risk, obviously McDonald's has a lot of competitors. You know, you have the well-known chains such as KFC and Subway, as well as lesser known but really popular companies such as In-N-Out and Five Guys. Also, another risk that McDonald's will face is changes in consumer tastes and preferences. If we look at the last 10 years, we've definitely seen consumers become increasingly health conscious, and they're avoiding fast food places, instead opting for healthier alternatives. As always, thank you for watching, liking, and subscribing. Let me know in the comments below whether you agree or disagree with the 6 shares I've discussed in this video. As always, an important disclaimer, I am not a financial advisor, this is not financial advice. This video and my channel is for general information only. As with anything in life, you should do your own due diligence and seek independent advice.